When is the real estate market expected to crash? So let's cover the possibilities here for you based on data and not fear, experience based on myths. As a real estate investor for over 30 years, I've been through some highs and lows in real estate. The current highs are nice. I've had properties that have doubled in value from 2017 appraisals to 2021 appraisals. One property went from $4.5 million to over $9 million in just that short period of time. So markets can move very fast and they can go up very fast, but they can also go down very fast. And in 2007, 2008, I lost homes. I got my butt kicked, and many people did too. Banks went out of business like Washington Mutual, and World Savings was sold. And some of these big banks had real trouble, like Lehman Brothers ended up losing the company completely. Other companies had to be absorbed, like Wachovia, that was absorbed by, I believe it was Bank of America. Many mortgage companies went out of business during that time, and job losses accelerated. Unemployment went up. So let's talk about the when. When do things go south? Number one, interest rates go up. When interest rates go up, affordability of homes go down. That's a problem. Right now, that isn't happening, but as the debt goes up and inflation continues to rise, there has to be a fine balance between raising interest rates to keep down inflation, but also being able to service the national debt, which is over $27 trillion. So what's going to happen here? Well, in terms of a when on the real estate crash, no one really knows, but know that real estate is cyclic, okay? There's highs and there's lows. Here's some of the signs. Besides interest rates going up, unemployment going up. The main thing that supports real estate is people's income. Income pays rents, pays mortgages. When income is lost, mortgages aren't paid, rents aren't paid. You get enough of that, you get an acceleration of people who can't afford to pay for their homes. They need to be foreclosed, or renters who can't pay for their home that they live in, their rent, they need to be evicted. Currently, there's a moratorium on evictions, right, in the United States. And so there's a restriction on getting people who can't pay out. There's also was high unemployment during the pandemic. That unemployment, because of the recovery and the money that's being fed into the economy, have helped to lower that, and people are starting to go back to work, and demand for goods and services is going back up. As long as people are getting paid, and as long as people are getting the money to pay their mortgages and pay their rents, you should continue to see a strong market. When you see jobs being lost and unemployment going up, you're going to see market start to implode. Now, is it going to implode all over the country at once? Absolutely unlikely. What's more likely is that will implode locally. For example, if you were working on the Keystone Pipeline and you had all the wages coming in there, and those are usually prevailing wages, meaning they're high wages, people are getting paid, and then all of a sudden, politically, they decide we don't want to have the pipeline right now. All those jobs go away. You may see locally, and likely will, people that don't have the money to pay rent, they don't have the money to pay their mortgages, and that local market may begin to have some real challenges. So depending upon whether you are a market that's growing and expanding, like in Austin, Texas, like down in Florida, Jacksonville, some of these other areas that are continuing to grow, or you're in a market where the entire market is dependent upon jobs, say like the auto industry. When the auto industry goes bad, the economy goes bad and the market begins to implode. It wasn't too many years ago that I had friends that were buying property in Detroit like crazy because the cost to rebuild the homes was so much higher than what you could buy homes for, and the banks just wanted to get them off their books. There was too many homes and not enough buyers. So investors came in, held on to them, and waited for the market to recover. And that market has recovered in many parts of Michigan, Detroit particularly, from many years ago. So these markets can move. They're up and down, and you want to be sure that wherever you're investing, you have a diverse job base. So if one employer leaves, you have other employers that can support the job base and give people income to be able to buy and pay rent or buy homes or pay their mortgage. In the San Francisco Bay Area, where I grew up, we saw devastation during the Clinton era when many of the military bases were closed. As a result, my father, who was in the Navy, captain in the Navy, worked at one of those facilities and had retired. And shortly after he retired, many of the bases in the Bay Area were closed. And that had a definite economic effect on the Bay Area because that was billions of dollars that were coming in payroll and jobs to the Bay Area. Alameda, Naval Air Station, Mare Island and Vallejo, Oakland Supply Depot. All of these were big employers that lost a lot of money and health benefits all at once because of restructuring of the military and budgeting during the Clinton era. So what happened? We began to see crashing around because the people didn't have the money, and that economic engine that supported so many people began to be lost. So when you have a job or an employer go away in a particular area, watch that market for a potential crash. And when you're investing, make sure that you're looking at multiple markets, and make sure when you look at multiple markets, even if they're within a 2-hour radius, that there's employers there to support them that have viability. Okay. In Reno, Nevada, our government at the time, Governor Sandoval, negotiated a deal to have a battery factory in Reno for Tesla and other cars, but mostly for Tesla, okay? Well, that boomed the area. Now, Tesla was, for a time there, it was, as Elon Musk will talk about, he was having some real trouble financially, and he pushed through, and now they're fine. But that particular time caused a lot of people to buy because we had this new employer. Now that employer is stable, it's going to be there for a while, you're going to have an unlikely event of a crash. Prior to the diversification of the Reno market, prices were a little bit soft because all you had was casinos. Casinos began to lose customers because as people were driving up from the San Francisco Bay Area to Tahoe and Reno, they were passing these brand new Indian casinos that had been built in Lincoln, California, in Cache Creek, California, in the Bay Area. And so they were like, well, why would I drive to Reno to go to the casino when I could go to these local ones, right? And so that hurt the market, okay, at that time. Now I'm going to tell you what's happening now, but first make sure you subscribe so I can show you how to earn and how to make money in real estate. I've been doing this for many, many years, been through many cycles, and all I can do is give back. All I can do is pay it forward because the people that helped me, some of them have passed away, and I can't really give it back to them. I mean, they're already rich and they're successful, or they're retired, and that information isn't helpful to them. But it's helpful for you as a real estate investor or that person who's trying to figure out what's going on in the market. So when we look at the Bay Area today, the market's pretty strong in most parts of the Bay Area, although people are moving out of the city of San Francisco because they can work from home remotely and they want more space. That market's strong. When we look at the Reno Tahoe market, we're now seeing this fundamental shift where people, because of the pandemic, it has accelerated, made okay for many of these companies to have people work remotely, because what they found was that in some cases working from home, they were more productive. And what people liked is they liked the flexibility to work from home and to not have to commute and save those commute hours. So now places like Reno and Tahoe, especially in the Tahoe area, Big Bear down in LA, they're complaining that they have all this traffic now because instead of people coming up seasonally, people are now coming up and living there permanently. And that's putting demand on their infrastructure, their roads, and all that. So markets do change. And when the market changes, you're going to see the signs we talked about, and you'll find that as long as you're invested in areas that have strong employment and diversity of employment, you're generally going to be okay. So finally, as far as a date of when the real estate market's going to crash, I think you might see some challenges in certain markets where they've lost employment. You may see you're seeing a little bit of that in San Francisco, New York, LA, Chicago, but you're also going to see, and when the employment numbers or the economy changes or we get in some type of recession, that's when you'll start to see the real estate market crash. Most people see the economy very strong for 2-3 years. JP Morgan Chase says that. Other people say that. We're certainly not going to see this appreciation like we have, but we will see some flattening. But in terms of crashes, maybe locally across the country, barring any major economic event, war, something else, you may not see that till 2023, 2024, 2025. 2026. And no one really knows for sure, but right now with interest rates low and inventory low and demand high, there's going to continue to be buyers. We've got a lot of millennials buying homes. And lastly, and we'll end on this, some of the greatest transference of wealth is happening right now as some of these people, the baby boomers, the oldest is 75, and some of their parents, of course, they're passing away, and they're passing on wealth and real estate and income and assets to their younger generation. And they're going to now have financial horsepower to be able to buy and invest and do other things. And given the internet and the ability to invest in different places, you're going to have a lot of demand for residential income property and real estate, because most people realize that the majority of multi-millionaires who are self-made have invested and own real estate. You may have people that own stock, that own companies that have done real well. Those are the exceptions. You may have some Bitcoin entrepreneurs that have done real well. Those are the exceptions. The vast majority of people who've made a lot of money in the world have made their money in real estate or owning their own business. And in my experience, most of the people that own their own business invested that money, whatever their business is, I was a chiropractor, invested my money in real estate long term, was very patient, and held on to it. And that's how they built wealth. And in a similar topic, I did another video called What Happens If the Dollar Crashes to the Real Estate Market? And we'll talk about that in the next video.